Welcome back to Rich Owl. In September of 2024, Oracle stock was $130 a share. 20 months later, it hit $330. A 150% gain in less than 2 years, on a stock that spent the previous 10 years going nowhere. The story? Artificial intelligence. Specifically, one deal. A $500 billion cloud contract with OpenAI. The largest single customer contract in enterprise software history. Every YouTuber, every analyst, every talking head on CNBC called it the deal of a generation. Larry Ellison's net worth doubled. He became briefly the richest man in the world. And in that same 11-day stretch, he personally sold $6 billion of Oracle stock. Insiders do not sell $6 billion at the top of a 30-year secular trend. They sell when they know exactly what happens next. This is Rich Owl, where we break down the stories Wall Street wants you to ignore. Today, I am going to walk you through why the Oracle rally is following the exact same script as Cisco in 1999, why the OpenAI deal is mathematically incapable of delivering, and why Larry Ellison is not the smartest guy in the room. He is the fastest one heading for the exit. 3 things in the next 8 minutes. First, the mechanics of the OpenAI deal and why it is a Cisco-style trap. Second, the customer concentration inside Oracle that literally nobody is talking about publicly. And third, the trigger that ends the rally, and 3 boring assets that historically win when hyped megacaps crash. Before September 2024, Oracle's stock had returned an average of 6% annually for a decade. Slower than the S&P 500. Slower than gold. Slower than a basic municipal bond. Then Larry Ellison announced the OpenAI deal, $500 billion over 5 years. The stock ripped from 130 to 330 in 20 months. But here is what people missed. That $500 billion is not $500 billion of revenue. It is contingent on OpenAI actually generating the compute demand to justify that spend. And OpenAI's own financials tell a different story. OpenAI is projected to generate around $13 billion in revenue in 2026. Its net loss for the same year is projected at $8 billion. 9 years after founding, $30 billion of investor capital deployed, still burning $8 billion a year. And this is the customer that is supposedly going to spend $100 billion a year with Oracle. For OpenAI to sustain that commitment, it would need to grow revenue from $13 billion to $200 billion in 3 years. A 15 times revenue increase. Amazon did not grow that fast. Google did not grow that fast. No company has ever grown revenue 15 times in 3 years, starting from a $13 billion base. Sound familiar? Because this is the exact playbook Cisco ran in 1999. Cisco sold routers to telecom companies that had raised billions in capital to build fiber networks that would not be fully used for a decade. The revenue was real. The equipment was real. The demand was real for 1.5 years. Then in 2001, the credit window shut. Cisco's biggest customers could not pay. Cisco's revenue fell off a cliff. The stock crashed 89%, and Cisco, in 2026, 26 years later, has still never recovered. Here is what nobody is talking about publicly. If Oracle actually books the projected OpenAI revenue, OpenAI would become 40% of Oracle's total cloud revenue. 40% from a single customer. That customer is losing $8 billion a year and needs a 15 times revenue increase to make the deal work. There is no version of that math that ends well for Oracle. If OpenAI misses even one milestone in the contract, Oracle's guidance shatters. The stock is priced for $100 billion in annual OpenAI revenue starting in 2028. If it comes in at 70, the stock loses 40%. If it comes in at 50, the stock loses 60%. And Ellison already knows. Between October 2024 and May 2026, Larry Ellison personally sold $6 billion of Oracle stock. His co-CEO, Safra Catz, sold $400 million. The board sold another $1.7 billion. Combined, insiders have sold over $8 billion in 20 months. This is not routine portfolio rebalancing. Ellison has been the largest shareholder in Oracle for 40 years. He does not sell $6 billion because he wants a bigger yacht. He sells because he sees the models. He knows what OpenAI's actual CapEx commitments look like. So what triggers the collapse? One earnings miss. OpenAI's first quarterly CapEx report that comes in below projection. Oracle guidance gets revised downward. Analysts downgrade. Passive index funds start selling. Oracle is now a Mag 7 Plus stock. The same passive fund selling that takes down NVIDIA takes down Oracle first. Because Oracle is the most concentrated single customer bet in the entire index. When Oracle falls 40%, Ellison will be selling from a cost basis of $3 a share, not $300. So what actually wins when hyped megacaps crash? Same three things that always win. Number 1. Long-duration U.S. Treasuries, ticker TLT. In 2002, TLT rallied 15%, while Oracle lost 78%. Number 2. Gold. In 2002, gold gained 15%. In 2022, gold gained 6%, while the S&P lost 18%. Central banks bought a record 700 metric tons last year. They are not buying for excitement. Number 3, the boring dividend aristocrats, Coca-Cola, Procter & Gamble, Johnson & Johnson, Walmart, Cintas. These businesses do not depend on a single customer for 40% of revenue. They do not need a $100 billion OpenAI check to survive. They just keep raising dividends every single year, forever. When the exciting stocks crash 60%, the boring ones fall 10% and recover in 18 months. Here is the realistic Oracle forecast. Best case, Oracle in 2030, $280 per share. Base case, if OpenAI misses guidance even once, Oracle sits at 180, a 45% drop. Cisco scenario, if OpenAI cuts CapEx hard, Oracle sits at 70, 78% drop. Same as Cisco from its peak. Oracle is a real company. The technology is real. The problem is not the company. The problem is the price. The problem is one customer accounting for 40% of the story. The problem is that the man who built the company just sold $6 billion of it. Stay curious. Stay skeptical. Never confuse a great story with a great investment. I am Rich Owl. Cheers. Stay curious. Stay skeptical. I am Rich Owl.